Now, earnings margins are being compressed, and the reason they're being compressed is that corporate earnings are basically benefiting from the productivity of the machines that they put in place instead of the people. Now I think they're at a moment where they got to hire people. People are expensive, and so the profit margins will largely come down as they move from early cycle machine adoption to later cycle muscle adoption. Sentiment is improving, and I think this is the big story for this year. I would have told you that optimism will return, but I used that last year. But anyway, so consumer sentiment on this chart going back to 1993 is still sort of at recessionary levels, but it's coming off the bottom. Now, a lot of people talk about consumer sentiment and tell you that that's going to tell you something about retail sales. There's really there's low correlation to that. But what it does tell you is kind of how the stock market's going to go. Because consumer sentiment isn't very far away from investor sentiment. And the way we chart investor sentiment is the multiples on the market. And so when consumer sentiment starts surging higher, multiples in the market start surging higher, that's good for returns. And that's what we've been seeing. And so another way to look at this is consumer sentiment going back to 1972, and it asks the question, where is the market a year after consumer sentiment bottoms? And so here we are in August of 11, under 60 as a gauge. The average is 85. So we've been under there a few times. February 75, we went up 22% after that moment over the next year. 1980, we went up 20%. You can throw October 1990 in there. We went up 30% over the next year. November 08, we went up 22%. August 11, does anybody know what we've done since August of 11? We're up about 20%. So I don't know where we'll be by this time next August, but the pattern of recovery of sentiment leading to recovery, big recoveries in the market holds. All right, and in terms of U.S. valuations on the market, they are fair. So here's a chart using normalized earnings, which just means it takes into account the entire business cycle, going back to 1920. And what you can see is we are currently trading at 18.5 times normalized earnings. The average going back to 1926 is about 16.5 times. The post-war average is actually 18.5. So U.S. valuations are average. We are right in line based upon this. However, offshore, the story gets much more compelling. This is developed markets outside the U.S. going back to about 1970, and you can see the average is about 17.5 times. A little lower than ours, but not far. At the peak, pre-recession, we were at 30 times. Today, we trade at 10 times in developed markets outside the U.S. That is the end of secular bear market territory. I almost teared up right there. In the emerging markets, the story is similar. We don't have data going as far back because they weren't classified. But going back to 2000 and using 5-year trailing earnings, we were trading at historic lows in emerging markets as well. So while the U.S. is average, the rest of the world is pretty darn cheap. Valuations matter a lot, okay? I hadn't been able to have this conversation with you because when I came to town in 2000, the S&P was trading at 30 times earnings, and so we couldn't really talk about valuation much. But now that the S&P is down to 13 times earnings, we can talk about it. And so if you go back and you look at all the data going back to 1926, and you say, if I bought the stock market between 12 and 13 times earnings, what's my average rate of return 10 years later? Well, it's about 10 to 12%. Okay? I'll indulge you on a little math. Earnings on average grow about 6%. Dividends grow at about 2%. So if you have average valuation from a beginning of a period to an end of a period, you're going to grow about 8%. Okay? Add a little bit of multiple expansion to that, and you get into this 10 to 12% sweet spot where the data tells you that you are now. So that's good news. Unfortunately, it doesn't go in a straight line. Even though we've had 24 positive years in the last 31 years, every year holds a decline. Last year was a classic example. The market was flat last year, but from its high point to its low point, it actually fell 20%, 19% I think in this chart. So even up years are going to have losing streaks. I finally got that through to one of our clients who's not here tonight, and I'm so sorry because this was for him, that we're going to have a little bear market every year. So we kind of got to get used to it. And with the volatility that's afoot today, unfortunately, I think we're going to see more of that. But the fundamentals are sound. We just have to toughen up a little bit. All right, let's talk about the fixed income side of the equation. Duncan, you want to do this?
No, you got it.
Okay. All right, on the fixed income side, the first thing you got to question is whether inflation is a problem or not a problem. I would argue that inflation is not a problem. Even though the central banks around the planet have printed $7 trillion, none of it is circulating. And until that money starts really moving and getting out of bank accounts, you're not going to see an inflationary problem. That is going to be a problem, and we're going to spend some time on it in a future State of the Union, I'm sure, but at the moment, not a problem. In terms of the Fed, the U.S. Fed is more concerned right now with deflation than inflation. And so they've pegged the overnight rate at 25 basis points and said it'll be there for the next couple of years. And indeed, they've been trying to work down long rates as well. They're even threatening more quantitative easing. Recognize that if the Fed is successful at what they want to do, then we will have more economic growth, but we will also have more inflation. In that environment, you do not want to own a treasury bond. So treasuries, in my judgment, are for emergencies only. And here's another reason why. I'm not going to get into a lengthy economic discussion of financial repression, but when you hear that term, just remember this. Right now, the yield in the Treasury complex is about 1.1%. The Citigroup government bond index outside the U.S. is yielding 2.3%, and the enemy, for us, the Barclays Ag, is yielding about 2.4%. Inflation is 3%. So if you buy one of those bonds, hold it to maturity, and get your coupon, you are guaranteed to lose money. To get above inflation, you have to go to the credit side of the spectrum. So you got to go to emerging market bonds, you got to go to high yield munis. Do you have any of those for sale? Yeah. You got to go to high yield munis, you got to go out to corporate bonds, you got to go out to levered loans, and so you've got to go out the risk spectrum, which is where we are. Bit us last year, it's benefiting us this year.